All right. Good afternoon, everyone. Welcome to Quest Self-Directed Saturday. I'm so glad you guys are joining us today. We actually have one of the best topics that I like to consider out there. And this really comes down to it's because it's the number one questions that we always get asked. And you have to remember, I can't ever give you any type of tax advice, legal advice, investment advice, nothing along those lines. So a couple times throughout the year, we always like to bring in higher end CPAs and stuff like that specialize in a lot of what you guys are doing. So because the majority of Quest clients become real estate investors, we always like to reach out and search out for good real estate CPAs. So make sure as we go through today's topic, you have your questions ready. Now, a couple of housekeeping rules real quick. Leverage the chat box right in the right-hand side down below. You can post your questions in there. If it's a good one, I'll pop it up on screen so everyone can see it, right? So keep them appropriate. We've had some people have sometimes put some pretty funny things up there. Next is for the month of December. What we're doing here in December is if you'd like to set up a Roth IRA, it will be completely free. So always reach out to Quest. Let us know how we can help you out. And lastly, if you want to use the chat box to pitch your own investments, you're more than welcome to. So that way you guys can talk to one another and get started. So without any further ado, I'm going to get real excited here to bring on our main speaker today. And like I said, he is actually an expert when it comes to filing taxes and dealing with taxation in the real estate area. So without any further ado, Michael, are you with me?
Yes, Derek. Okay, thanks for inviting me. Always a pleasure to work with Quest. You know, we're going long time back, like when your uncle started. The thing is,
Absolutely.
yes, and I already was in business at that time. So, okay, my company is working exclusively with real estate investors, and between Quest and our company, we share quite a few clients. Okay, and what you guys asked me to talk about today, because we are doing that in December of 2022, and December is the month which is the month of flood of advice that you can see on podcasts and articles, even like newspapers. Some people still use them for a reason I cannot explain. But there are all of these articles. Okay, 10 hot tips. This is what you need to do before the end of the year. This is how you minimize your taxes, yada, yada, yada. So we'll talk a little bit about that. Okay.
Awesome.
And before we go, I just need to explain is okay, what is these red gloves
Right,
that
I was
are,
already saying, what's up with the boxing gloves? I always
yeah,
like that.
my yeah, on my logo. Okay, my logo is me punching out Uncle Sam, who right now is hiding behind me. You know, social distance just in case COVID is still around. And somebody needs to knock him out because dealing with the IRS is getting more difficult, not easier. And there is a lot of stuff going on, which we will mention. And also, I'm known when I'm on stage, I always wear that. And here is my black belt because I'm known as black belt in real estate taxation. Okay, so I wear that. I wear gloves, but right now gloves are off because I'm going to start talking about more serious stuff and less entertainment. Okay, so one of those serious things that we keep deflecting questions about, or like fielding those questions, is okay, what about that new army of the IRS agents that is announced by the White House?
Yeah, like
Okay,
70,
so does it
80,000
mean
new.
right now? Yeah. Oh, yes, yes, yes. And they're all like armed and they are going to start knocking on doors effective tomorrow morning, you know, and guys, like it's going to be a disaster. So let's briefly mention that. So, yes, the new law does authorize new, like, huge funding for the IRS, and part of that is hiring new people. Okay, so yes, there is a huge hiring uh, going on right now at the IRS. And simultaneously, people mentioned buying ammunition and all of that stuff. So let's like separate those two things. So first about guns and IRS
So, Michael, I'm actually going to turn the floor over to you so everyone can see
criminal
you. I'm
division.
still here in the background. Okay?
Okay, so we lost Derek's connection right now. So when he is back, okay, I'll let him finish what he was going to say. Okay, so as far as the arms, like what I was starting to explain is the IRS has always had criminal investigation division. That's the arm of the IRS that at one point nailed Al Capone. So ever since that division exists, and they do carry arms, they do knock on people's doors, but only on people who are under criminal investigation. So none of you, I hope, are in that group, and we don't need to talk about that. Normal IRS agents who we are dealing with, are auditors and collection people, have nothing to do with guns, and that's a good thing because communication is frequently heated, and if we go to that armed on both ends, it's not going to end pretty. So first, like, okay, let's remove that gun nonsense that some people in the media are trying to play up. Okay, we are not going to have a bunch of IRS auditors carrying guns and knocking on your doors. But what that army of the new IRS agent is really doing is they are hiring these people for all functions within the IRS. Okay, one of them, for example, is fielding phones. Okay, that's been horrible during the COVID years. Okay, because the IRS admitted that they only answer 1 out of 10 calls during this time. They don't have enough people to do that. So part of that group is going to do what we call customer service. Okay, I don't know how much of a service that would be, but at least they are getting more people to do that part of the job. Then obviously they are taking more people into audits. So yes, we do expect a sharp increase in the number of audits. That during the last 3 years, during this COVID craziness, we had no audits whatsoever. Audits were on freeze. The IRS had other priorities. They got behind on processing millions of correspondence, still behind horribly on that, but audits were not really a thing. And right now, with all these new people coming in, we are going to see a lot of audits. That's what my expectations are in the near future. The message to you from that would be that what you need to keep in mind is if you believe that the cat left the house and the mouse has a full control, well, maybe that was the case for a little bit, but not anymore. So all of your super aggressive things and strategies may need to be tempered a little bit right now if you are trying to be on the safer side. Okay, so that's as far as IRS agents. And yes, there is also new IRS collection people, not people with guns, people with phones who are calling you and, well, not actually calling you. The IRS does not initiate collection calls. If you get a call that says, hey, this is IRS, you're about to be arrested unless you send me $200 in Walmart cards right now immediately. Okay, yeah, that's obviously a scam. So, but there are a lot of letters, a lot of collection activities, so they are going to increase that. So yes, the IRS is hiring. There are more people. There will be more hassle dealing with the IRS, but nothing really changes as far as business at the IRS, and there is no, like, it's not going to be another law enforcement division of the government that you have to worry about. We have enough of that already without the IRS. So I hope that we can stop this conversation, put this to rest and move to discussing other things. Now, okay, Derek is back. Derek, you were starting to say something when you lost your connection.
Oh no, yeah. All I was saying was, I was like, hey, look,
Derek,
I was just gonna remove myself so people could listen and watch you. I know we have some other stuff you're gonna show us, so just let me know. I'm here in the background for you. So, and then I was just kind of letting people focus on you and your firm. So.
Okay, good. Okay. So we'll continue. Okay, there is one other thing as far as big concern related to the IRS changes that people are talking a lot about, the threshold for 1099s. Like a lot of you heard about that. If you have notes, give me bear with me for a minute because I need to explain the basics, and then I will comment what my perspective on that is. So traditionally, okay, when you have contractors, you have obligations to file 1099s for labor that these contractors provided you. Most investors know about it. The threshold has always been $600, and it's $600 for a year. So if you have that plumber and he had one job for you that was a $300 job, then another one $400, okay. Separately, each of them is under. Yes, go ahead.
There. Yeah, I'm sorry. Hey, Victor, can you hear me? I'm going to bring you up real fast. So, Victor, I'm getting some messages saying there's a ton of people waiting on YouTube and it hasn't started for them. Victor?
Hello?
Yeah. Hey, Victor. Yeah. So, like, I'm getting these messages saying there's 45 people on YouTube here and there's other people over this way waiting. And
yeah, I'm looking into that right now.
All right.
Yep. Should we pause?
Yeah, yeah. So in the meantime, you and I will just kind of chit chat. There's still some people on here. So for those of you who are waiting, I want to make sure everyone's getting enough information out there. And so I'm not sure what's going on, why YouTube didn't stream this out as well. So pretty much, let's go over some quick dates. Is that okay? So I know there were some communication errors and stuff like that with the SEP filing deadline. Did that get extended this year for a retirement account? Can I still contribute to it?
Not as far as I know. Okay. I cannot give you a definitive answer and promise, that's the case, but I have not heard about extensions.
Yeah. No, yeah.
Except in Florida has extensions related to hurricane. But nationwide, I don't believe so.
Okay, that's probably why there's so much miscommunication on it and stuff like that. So, getting some other questions up here.
It could be related.
So, a couple questions that are just popping up as they're fixing the YouTube thing is, can we cover a little bit on Roth conversions? So, right now at Quest, we see a lot of people do conversions right now. But when I see people do conversions right now, it's a really small amount. And in January, I see really large amounts. But a lot of times people are just worried that the Roth IRA is going away. So can you comment at all just on, should we be doing more conversions, less conversions? Obviously, we want to get as much money in a Roth as possible. But, you don't get any tax deductions or anything like that moving forward. So,
yes, that was on my list. I just need your guidance, Derek. Do we wait for the technical issue to be resolved? So more people on the call?
Yeah, let's just wait. We'll wait. So those of you that are listening, we're going to give it 2 more minutes. I know my IT team is working on it. So, how fun.
Okay, well.
I was wondering why, too. I was like, there's not a lot. Our Saturday classes usually are so packed full of people. So I thought it was weird that. Janet, yes, Neil, Mary, I see your questions popping up here on the right. So they're getting those. And Janet, yes, we will be covering some Roth conversion stuff here in just a moment.
Okay. So I completely understand my previous career was IT, and I don't envy my former colleagues. Technology is getting crazier, and we have IT issues all the time because, just like everybody else, all business is remote right now. So we don't meet nobody comes here in the office anymore. All clients are remote, and every time something is off on their end, on our end, technology. So it's hard. Yeah, the whole world is trying to communicate.
Boom. All right. Wait, so Michael, we are back. I do see now it's they got everything working, it looks like, on YouTube and stuff like that. So I'm just gonna kind of let you keep continuing if that's okay.
Absolutely. Okay. I'll just use a couple minutes to quickly recap what we were talking about for the first few minutes before we had people from YouTube and other links joined us. So we started a webinar knowing that some of the Quest people were not able to join. So, I apologize for that too, even though personally I couldn't do anything to fix that. Luckily, Quest IT team fixed that. So we are all together now. And what we started talking about first is that fear that media plays up recently is hiring a bunch of new IRS agents who are supposedly armed and are about to knock on your doors, and that's the typical media BS. Yes, the IRS is hiring a bunch of people. These people are going to do phone support. These people are going to do audits. These people are going to do the usual collections, but they are not going to be armed and knock on your doors. The armed part is only criminal investigation division of the IRS, which is not new, which is going after people who are suspected or convicted of tax crimes. And just, okay, guys, don't do tax fraud. Simple as that. So, okay, we'll move past that. And our next topic is changes in the 1099 system. So the 1099 system is, if you have contractors, everybody know, like pretty much everybody who is in business, especially investors, know if you hire labor and that labor was more than 600 combined for the year, you are supposed to give these people 1099. But and that threshold was $600, but that's payments for labor. Okay. In addition to that, and that is always confused, we are talking here about 1099 self-employment labor form, which is 1099-NEC, okay, non-employee compensation, NEC. But there is a different 1099 form, 1099-K, and that form has nothing to do with labor. That form reports payments that a business received through electronic means, like, for example, like PayPal, right? So if you are a business, okay, in my firm, for example, most of the invoicing goes through PayPal. So when we bill our clients for tax and advisory work that we do, so PayPal processes those payments, and at the end of the year sends 1099-K that says my company, which is called REI Tax Firm, made that much money through PayPal from work. And copy of that form goes to the IRS. So when I do taxes for my own firm, the IRS already knows how much money I made through PayPal. We also use another provider, another payment processor who who processes different type of billing that we do for clients. So we also get 1099-K from that other company. So if we had like 5 different credit card and payment processors, we would get 5 different 1099-Ks. And the IRS computer will make sure that what I report as my income will match those 1099s. And people who were doing a little bit like of side businesses really didn't have to worry about that, because traditionally the threshold for reporting was $25,000. So if you did less than 25,000 billing through those systems, the form was not issued. You were still, like, let's be clear, you completely had to report that income. Like, the IRS never excluded that income from reporting. But the IRS did not have an automatic notification through your PayPal or whatever other company you used to process your payments that you made this money. They did not have that form, so they could not really check on you, so to speak. So again, you legally had to report that, but the IRS did not have spies telling the IRS how much you made through their systems. And recently that threshold was dropped all the way down to 600. So right now, if you build somebody just $1,000 for something through PayPal, PayPal is supposed to send the IRS a report for even that small amount, which freaked out all of the freelancers and everybody who does sales online, you know, for all kinds of small transactions. Everybody panics. So there are 2 things I want to say about this new law and what we expect from them. So number 1, it completely could be reversed. So there is significant push from many lobbyists and many organizations who for various reasons don't like that idea. And one of the biggest arguments that people raise, that's a very valid argument. that is going to create a lot of double reporting, a lot of false alarms. Because here is an example: is okay, let's say that you process the payment through PayPal, and PayPal sends the IRS form saying is, hey, you made $1,000 through PayPal. But the guy who bought it from you can also send another 1099 to you for providing services. Now you have the same 1,000 reported twice on 1099K and then on 1099 miscellaneous or 1099 in NEC. So there is double reporting threat. There is like a lot of situations where saying is like, wait a second, that wasn't really business income. So yes, there is a huge push against that obnoxious rule. I hate the rule just like you do. I don't want it to happen. So far, it's going to happen as we speak today. But anytime right now, they can come to their senses and remove that rule. And I hope that that happens. If it does not happen, we'll have to deal with that early next year. Okay, now the other part about it is what payments actually do get reported through that. And we need to be clear. Okay, let's talk about things, for example, which everybody does is like Zelle and all of those. Okay, these companies have two different channels. You have personal channel and business channel. Personal is when you don't pay fees for the transaction. You know, when you do the payment and they ask you, is it payment for friends and family? And everybody learned by now, if you say friends and family, then they don't charge you a fee. If you're saying it's a business payment, then they charge you a fee. Okay, only that second type is going to be reported. So if you are doing the first one, like friends, family money transfers, those are not part of reporting by the company that processes your payments. And policies of those companies are also a moving target. So it's a good idea to double check current policies of these companies. But I want to be very clear that what they are going to report, even if that becomes the law, is only those payments that were channeled through business portion. Now, does it mean that you have to process all your business portion as non-business? Well, that's what we call fraud. I mean, you obviously can, but that's fraudulent. Okay, it's only designed if you really are like making transfers between family and friends for non-business transactions. Okay, now if you are doing your business transactions this way, it's on you. Okay, but the companies who process that are going to look if you acknowledge that being a business transaction, if they charged you a fee for doing that transaction, then it's subject to reporting. And if they don't change the rules, then yes, next year, everything that you process during 2022 through business part of PayPal and all of these companies will get reported if you received 600 or more in those payments. Very unfortunate development. And like I said, I'll repeat one more time. I hope that they will cancel that before it becomes effective. But as of today, it's still the thing. Now, what are the changes for the next year? Really, we don't expect anything. When we talked a year ago, and a year ago I was doing a similar webinar with Quest and with and through other friends and partners, we have lots of recording of December 2021, because back then we were really concerned about a new tax plan of Biden administration, and we expected multiple things to potentially materialize and become bad news. But none of that happened. And right now, at the end of 2022, I do not expect any changes to our tax system the next year. 2023, don't think anything is going to happen. Administration has a lot of other priorities right now, and I just don't see how they are going to go back, particularly right now in the split Congress, and try to push any kind of tax changes through the system. So I pretty much expect next year, with the exception of that $600 reporting on 1099s, everything else we expect to be pretty much the same. So there are no new tips or alarms that we need to ring right now in December 2022, saying is, guys, the door is closing. Okay, something you have to do immediately, or you won't be able to do it next year. So business as usual is what we expect. Okay, now when we talk about those December things, so what you do, what you don't do in December, the list is very long, and my pet peeve, one of many of my pet peeves, is those blog posts and podcasts in December, which investors love to do, bring in, experts or half experts or no experts at all, and talk about hot tips that this is what you need to do to drastically reduce your taxes. Boy, and what a loophole we just talked about. Okay, so I don't like any hype on anything. And a year ago, I wrote a long post that goes through that list. So what I'm going to do right now is, okay, Victor, I will ask you if possible to share my screen right now. And what I'm going to do is I'll put, we have on the screen right now this post, which is on Bigger Pockets. If you are not member of Bigger Pockets, you need to be. That's one of the best, if not the best, networking websites for real estate investors. And I'm one of the top contributors there to the tax forum. And that was done a year ago. And that's a very long, post there. So we're not going to go through that right now. But I will ask Quest to send a link to that post for anybody who is interested. But
yeah,
I'm just
no problem.
Okay. Yes. I'm not sure. Like, I look right now on my screen, I don't see, guys, like I can copy and paste, but I frankly don't see how where would I where can I post it?
In the right-hand side, you have a comments button or a private chat button.
Uh-huh.
Yeah, so go ahead.
Yes.
You can put it in either the comments button or the private chat button, and then I can post it right up for people.
Okay. I'll put it in private chat because for some reason in comments, I don't have an option to post. Okay. I can see the comments, but I cannot post. So I just, Derek, I just did it. Give me a second. Okay. I put it in private chat right now. Perfect. Okay, so if you can copy it in the comments so everybody can go there if you want to. We're not going to spend our presentation time through that, but I'm just going to illustrate. So in that post, I go through a few things. The first group talks about things that are not really tax strategies, but mentioned a lot of times. Here is an example. People saying is, okay, form an LLC. Well, forming an LLC does not change anything for you on your tax return. Maybe you need an LLC, maybe you don't need an LLC. That's an excellent topic to discuss with your attorney and with your CPA. But it's not a tax strategy at all. So it does not belong in the conversation. Or when people saying is, oh, you need to buy more properties. Of course you need to buy more properties. You are a real estate investor, for crying out loud. But that's not a tax strategy. Okay, next one is tax strategy that are not end of year tax strategies. And people talk about is okay, one of the examples here on that list will be is okay, accelerated depreciation, bonus depreciation, section 179, all of that stuff. Okay, so is it a tax strategy? Yes, but it's not something that you do at the end of the year. This is something that your CPA is going to do on your tax return next year when they are working on your taxes. It's not something that you implement right now, okay? Or form a corporation. Forming a corporation in December is probably not something that is going to change your taxes for this year. So why it could be a good tax strategy for you, again, it's not something that you need to urgently do before December 31st that is going to change your situation. There is cost segregation on that list, but that's a separate topic for today. So let me hold on cost segregation. I am going to talk about that specifically in a minute. So the third group really is the tax strategy that are for end of year. And those tax strategies, what they often do is they talk about moving things between the years. So when are you going to do something in December or in January? Like you are planning to buy something. Do you buy it in December? Do you buy it in January? You are planning to receive an income. Do you want to bill for that and receive it in December, or do you want to do it in January? First, most important thing there is you cannot have a generic answer to that question. Normally, here is the thinking of people, and we are going to tie it to a question that one of you guys asked earlier, and Derek posted that question. Like we saw that question about Roth conversion. That's a great moment to talk about Roth conversion. So Roth conversion, so first, generally speaking, Roth is a superior vehicle to traditional IRA. So if you have non-Roth accounts and have an option to convert it to Roth, you probably should do that. Okay, that's a rather generic advice, like again, not specific. Everything in tax law is case by case, but the general rule of thumb, Roth is better. So then people say, okay, I'm going to do Roth conversion. Here is the thing about Roth conversion. When you do it, if your account right now is worth 100 grand, and if you do conversion, then on the day of conversion, that 100,000 becomes taxable. Now, why you do that? That's a different conversation. Quest has so much training and information about different type of accounts and benefits of Roth. I don't need to be doing that. Like Derek, if while we are talking, you can find a good link to one of your many educational resources that explain benefits of Roth, just post it there. I don't want to repeat that. Okay, Roth is better, conversion is great. So the reason is, why do you want to pay taxes on the conversion now? Because it creates long-term massive benefit for you for your wealth growth. So yes, but the question is, do you have the money to pay taxes on that conversion? And that's where timing comes into the conversation. If you do conversion in December, then you have that 100,000 taxable in December 2022. When taxes will be due on that Roth conversion? For that year. So they will be due in April next year. So just like 4 months down the road. What if you wait with your conversion until January? And we had a little chat personally with Derek about that. And Derek said like, yeah, in Quest, we have most of the conversions in January. And primary reason for that is because if you do it in January, then the income for the conversion is January income. So it will be 2023 income. And taxes on that conversion will be due in April 2024. So you would have an entire extra year to wait to pay taxes on that conversion. And for most people and saying, oh, great, then it's a no-brainer. That means I don't need to do any conversion in December. I need to do it in January because I buy extra time, like extra year to pay taxes on that. Maybe yes and maybe no. There are other things that come into play, and I will mention just two of them. But when you talk to your CPA, your tax advisor, you need to discuss those issues as specific to your situation. In my company right now in December, we have back-to-back meetings with our clients, and we give different advice to different people. All depends on their situations. So what are the factors? First factor is level of income. Okay, so if you have a very low income in 2022, which is the situation for many people. For some, it's unfortunate because things didn't work out the way they planned. For other people, it's intentional because they are preserving capital and waiting for better deals down the road, whatever your reason is. But if in 2022, you did not have much income and you expect a huge bump in 2023, it actually may be beneficial for you to do conversion now in December, because that conversion will be taxed at a lower tax rate. You will be in a lower bracket. If you do it next January, yes, you're buying yourself an extra year, but you are also increasing your tax bracket, then overall tax on that amount that you are converting. So if you are in that situation And again, the situation I'm talking about, your income in 22 is much lower than the income you expect to have next year. Then you have an incentive to do conversion now. Here is a different type of incentive. What kind of assets are you holding in your retirement accounts? So what a lot of people have there are, especially you guys, you are Quest customers, you have self-directed accounts. So people who are not in that arena, who use traditional custodians and have traditional retirement investments, they are talking about stocks and mutual funds. Okay, most of you, what you hold there are different type of assets. Okay, you have notes there, you have private, we are doing private lending out of that, you own businesses, you invest in syndications through that, and a lot of you are doing crypto investments inside self-directed IRAs. So those things behave differently. And what is very important to understand is this: you are paying taxes on the value of your account on the day of conversion. And I will use crypto because right now it happens to be a very good moment to bring that as an example. Okay, crypto right now is in the toilet. Now, if you have crypto assets in your self-directed IRA account, the question you need to ask yourself, not me, I don't know any better, not Derek, even if Derek knows he's not allowed to give you any investment advice due to his position. So, okay, ask yourself or ask people who you believe are worth listening to about crypto. And the question will be, in January, is it going to go up or further down? Because let's say you have right now, you invested 100 grand in crypto and right now it's only worth 10. Okay, first, I feel your pain. Second is, my question is, what is going to be in January? Do you expect that 10,000 to slide even more down and be 8 or 5 or 1? Or do you expect that 10,000 double and become 20,000 or quadruple and become 40,000 in January? That's a very important question, because if you wait until January just because you want to kick the tax can down the road, but by that time in January, your 10,000 worth of crypto became 40,000. Now you are paying taxes on 40,000 in January instead of 10,000 today. So when you make that decision, it's not a no-brainer. You have to really look hard at what assets you hold in your account, put a value on that, and then become comfortable with your expectation of which way it's going to go in January. And only then, and also look at your income this year compared to next year. There are other considerations as well, guys. That's not only two. So that's a complex decision. And if you don't have the stomach, the patience, the time, or good advisors or whatever to discuss that question specifically, here is one strategy you can use that is like neither here nor there. Split it in half. Okay, convert half in December, half in January. Then at least you mitigate your risk and risk of missing out and all other risks, and saying is, oh, well, okay, I'm not sure which way it would go, but either way, at least half of them I did today and half I waited until January. Now, also, there is, if you are doing any conversion of Roth account in December, there is absolutely no reason to wait any further into December. If you want to do conversion in December, do it today. There is no reason to wait until December, like the last few days of December, when Quest is going to be overwhelmed with tasks and be swamped. Do it right now, okay? And whatever you want to do in December, in January, okay, then you do it in January or at any time during next year. So that's as far as tax strategies that are end of year. And the reminder is everything is case by case, okay? And those topics are very much worth discussing with your tax advisors one-on-one. Victor, thank you. Is okay, I don't need the screen anymore. Okay, we guys have the link and you can go through that. But right now I need to pause and explain a couple things. What I expect after you read that, that you might want my advice on your specific situation. Sorry, guys, will not be able to do that. Okay, so if you are emailing me personally, trying to call me and ask those questions, we cannot do it. Okay, I apologize, we don't have the capacity. The only consultations we provide is consultations for our firm's clients, and we have that booked back to back for the rest of the month. Now, if you are interested in becoming our clients, absolutely do that, please. Okay, and Derek, if you can also type in comments, the website for the company is reitaxfirm.com. REI stands for real estate investment, so reitaxfirm.com. That's who we are. Okay, if you are interested in working with us, please do that. Click on the link. It explains what services we provide. It has a contact form, and we can take it from there and see if we are a good fit and could help you grow your business and become tax efficient. Okay, and for those of you who joined us later and missed the introduction, okay, I'll spend a few more seconds. So I'm Michael Plaks. I'm known as Black Belt in real estate taxation. So wear this black belt during my presentations, and my logo has me wearing my sparring gloves, punching out Uncle Sam. What we do is for the last 25 years, my company has been working exclusively with real estate investors, providing tax strategies, tax return preparation, advice, business guidance, and all of that just for you guys, for real estate investors. Okay, so I promised as we were looking at the screen that I will comment on cost segregation. So why I would comment on cost segregation is because cost segregation is that like hot topic right now. Everybody is talking about that, and it's almost like, hey, if it's such a fad that investors almost like look down on other investors and, oh, you didn't do cost segregation? Wow, how lame. No cost segregation and you call yourself an investor? Okay, I hate those conversations that totally miss the big picture. And what I also don't appreciate is cost segregation companies. There are some companies who do very ethical business, and there are some companies who put out a lot of hype and make you think that cost segregation is that magic tool that erases taxes for everybody. But they fail to explain the big picture. So I will spend a few minutes right now of our presentation talking specifically about that. So before we go there, is cost segregation is not for your self-directed IRA assets. So this is a strategy that has nothing to do with the IRAs. This is strategy that you put towards the properties you own in your taxable universe, the other side of the fence, which is reported on your personal taxes and which is not part of your self-directed account. And also it has nothing to do with flipping business or wholesaling or those types of investments. So cost segregation strategy strictly applies to rental properties and rental properties that you own yourself. So as opposed to rental properties that are owned by syndications that you invest in. If you are investing in somebody else's syndication is going to make their decision about cost segregation. They are not going to ask you. They are going to do what is best for the syndication, and they are going to give you the results. So there is nothing you need to do about it or ask about or worry about. Well, worry maybe, because a lot of syndications are not doing cost segregation wisely, but nothing you can do about that. Again, they are making that decision for you. So where you are making decision is really restricted to that. I hope we are now on the same page. We are only talking about rental properties that you own personally yourself, direct ownership, and not inside retirement accounts. So outside of retirement accounts, property that you own. What kind of rental properties? Doesn't matter, all of them. We are talking about long-term rentals, short-term rentals, multifamily, single family, commercial, doesn't matter. All kinds of rental properties. So what cost segregation does then is we're not going to talk mechanics. Okay, I am pretty sure, Derek, confirm for me that, please. I'm sure that you guys have webinars recorded with cost segregation companies, right?
We do, yes.
Yes.
Absolutely.
Again, that would be great if while I'm talking, you can find the link, and put so people can also, get see some presentation or like if you have a blog post or article, from your resources. Okay.
Yes,
And I was on I was on multiple podcasts with my friends who do cost segregation. So that's a great thing. And you do want to know the details. But my job today is not to discuss details. My job is to put it in a big picture frame. And the big picture goes like that. So if you have those rental properties, what cost segregation accomplishes is enhances your deduction significantly for the first year of owning the asset. For 1 year only, you get a huge additional deduction on depreciation. So one thing to take home from my explanation is this: it's 1 year deal only. It's not an ongoing deduction. Once you did the year you did cost segregation, that's when you get that huge boost of deduction. The next year, unless you bought a new property and did cost segregation on another property, then there is cost segregation is done. In fact, what cost segregation does is it takes the same depreciation that you had earlier. It does not create new deduction. A lot of people are under an impression that cost segregation creates deductions that otherwise you did not have. No, it's not new deduction. What cost segregation does is reaches into future depreciation and brings it forward. You just eat your dessert before you eat your dinner. So you have the deduction first. But what it means after that, you don't have the dessert anymore. You have already eaten it. So all it does is it's the same deduction you would have eventually received that you get one time in the first year. Is it good? Yes, if you can do that. And that's where that second part of big picture comes. In order to benefit from that, you need to be able to take more deductions from rentals. Can you do that? Maybe yes, maybe no. It's case by case. We have a lot of new clients who come in our, who contact us to become our clients, and many of them are referrals from Quest, which I greatly appreciate, Derek and everybody else. Okay, so but a typical profile of these clients, and some of you guys are right now on the phone, is okay, you have a good professional income, you are making good money on your W-2 as doctors or engineers, and you are buying real estate in order to build passive stream of income and wealth, and that is all good and highly recommended. All of that is great. But then you listen to that podcast, and podcast says, okay, now you do cost segregation, and now you have this huge deduction, which will reduce your income. No, it will not. Because if you are a single person and you have high income from your W-2 job, you cannot take actions. They will be limited by a situation called passive activity rules. We don't have time today to discuss the details. Discuss it with your tax advisor. Okay, so you will be limited. Now, okay, but I'm married. Okay, what is your spouse doing? If your spouse is also a high earning professional, have high paying W-2 job or high paying 1099 income, not from real estate, still the same thing. You cannot do that. And then people read more YouTube, watch more YouTube videos, more podcasts, read more, silly articles from those like millennial reporters who believe that after they read 2 articles, they understand taxes. Okay, and then they're saying, oh, you just need to check the box and be real estate professional. Real estate professional is a loophole that allows you to take more deductions. That is correct. That allows you to take deductions even if you are high income. But that's not a checkbox. You must qualify for that. And you cannot qualify for that if you have both of you in the family making high income outside of real estate. If you have full-time jobs, you can. When you can qualify, okay, you are a professional making high income, your spouse is a full-time realtor or full-time investor. Oh yes, in that situation, it can work miracles for you. But you need to be in that situation. So before you get all excited, oh, I'm a doctor and I finally figured how I can reduce my taxes. I buy properties, I do cost segregation, I check real estate professional. No, cannot do that. So be careful. Make sure that you are in that situation. And we only have time to mention one more loophole and we'll be done for today. The loophole is a lot of people are talking about it, and I don't even like calling it loophole. It's not a loophole. It's a different kind of investment that has a different tax treatment. Okay. So loophole is usually something that is hidden, not known. It's not hidden. It's all out there. It's misinterpreted, misunderstood, but it's not a loophole. It's short-term rentals. So your Airbnbs, Verbas and all of those properties, right? So yes, but it's a completely different model. And it's also not an automatic permission to take all of the losses. So in order to have your STR, which stands for short-term rentals, right? So you have short-term rentals, you put this property on Airbnb, and right now we have some people who contact us. Okay, it's December. I want to quickly reduce my taxes, so I'm about to buy a new property, put it on the market in time for the holidays. So somebody will move in and spend Christmas in my property, and then I'm going to do cost segregation and I'm raising all my taxes. Good plan, right? Was that wrong? No, it's not that simple. If you buy that property in December right now, you may not qualify for what is known as material participation in that property. Also, if you are buying that property and you are hands off, hiring a management company that is doing everything, you probably won't qualify for material participation either if you don't have that material participation. And even though it sounds, oh yes, absolutely, I materially participate. Guys, in your mind, maybe, but IRS has very specific rules that define what it means. And again, that's something you need to discuss with your tax advisor one-on-one to decide, will you be able to benefit from that? And also, it's not just a tax decision, because if you are buying short-term rental, you're buying a business. It's not an investment. This is something that requires an ongoing participation, ongoing headache. That's not something that you can invest money in syndication and then it's on autopilot. Other people are doing that for you. Can you put STR on autopilot? Yes, but then you will not have material participation and will not have those tax benefits that you might be looking at. So it's business decision first, tax decision second, and the only way for you to make a good tax decision is to consult with people like me who specialize in real estate and can give you specific advice. So I know that there are a bunch of questions. I will let Derek control, we don't have much time left, but I want to mention one thing is.
Yeah, so I'm going to kind of pop up some of the questions, but there is a lot of them. Obviously, we're not going to get through all of them.
Derek, give me 1 sec. Derek, sorry, give me 1 second. I just want to clarify one thing. So where can you get answers to those questions? Okay, because after that, if you are trying to just email that question to me, forgive me, I will not be able to provide those one-on-one consultations unless you are our client, right? So there are two ways you can get questions like that answered for free. One is on Bigger Pockets, the place which was on the screen when I was showing my blog. You can join Bigger Pockets. There is a tax forum there, and there is me and 20 other people like me who answer those questions for free for people who are members of Bigger Pockets. That's an excellent way to do that. And if my screen for another second, online, and if not, just on Facebook, guys, on Facebook, I have a private group there which is called REI, Tax and Legal. Okay, Tax and the Legal Wizards. That's a private Facebook group, and if Victor has a chance to put it on the screen, okay, you will see that group. But just find that group on Facebook, and that's another group where we have multiple tax professionals answering questions for free. Okay, after the, but if you try to reach one-on-one, sorry, we will not be able to do that. Derek, back to you.
Yeah, no worries. So I got a couple of questions on here. One of them has to deal with paying contractors to install material inside their personal home. Should you be cutting those contractors to 1099? I mean, I would say no.
1099 is only. I said no, right? Yeah. 1099 is only for people who provide services to your business, not to you personally. Perfect. So if they work on your investment property, yes. If they paint your house, no.
Love it. Love it. Next is, I got one here about just owning some long-term rentals, and they're talking more about like, hey, look, I want to supervise, and I'm supervising a lot of the renovations on the rentals. Can that count towards me being my real estate professional, like those hours I need every single year? Supervising the contractors.
Okay, that's a good question. Okay, and first, like it talks about, I mentioned real estate professional, briefly when we talked. So this question, for those who don't understand the question, I need to put it like in context. So I said that you have to qualify as a real estate professional. That's not a term. To qualify, you need specific requirements for number of hours. And the question that we're answering right now is, what counts towards that hours? Can I count the hours of supervising contractors? Okay, we need to define supervising, and I'm not trying to avoid answering. Reason for that is this. There are court cases where those situations were litigated between taxpayers and the IRS, and the IRS won, because the tax court said is like, just because you are standing there watching your contractor do the job is not supervising. Okay, that does not count. Now, if you are actively engaged, if you are either providing, if you are actually participating in doing the job, or you are discussing with the contractor how the job should be done, yes, that time counts. But simply walking around the property, making sure that they don't drink beer during the time and actually do the job, no, that does not count. That's responsibility of your general contractor. And if you take it upon yourself, it still does not count towards that. So hours of being on the property can count as long as you do something productive there.
So now we're getting to a whole separate text. Now I'm getting other questions like, oh, driving around looking for the property, does that count? Or just pasting both bandit sides, does that count? So guys, with some of those, I think it's going to be more of a case by case. And yes. What was the website again that you said that where they could get some of those informations entered or questions answered from other CPAs?
There are Bigger Pockets, biggerpockets.com.
Yeah, the Bigger Pockets one?
Yes. On Bigger Pockets, there is tax. Then there is a group of Facebook, which has multiple colleagues of mine participating there. And what I did, Eric, is I just posted a link in a private chat to my Facebook group. If you can also share that with everybody, you need to ask permission to, like, that is a private group. So it's private, so we don't have any spam there, but when you're an investor, just ask for permission. We will admit you to the group. You can post some questions there, and maybe myself, maybe other people will chime in. Okay. So, okay.
So there's the link right there for you guys for that private Facebook group. One final question for you, Michael, before we get going, if you got some time, is we've seen at Quest a big shift from like single family homes. When I say that, it could be fix and flips, rentals, anything like that, to more the syndication levels. Right now, granted, I deal in IRAs, so obviously IRAs are going to be a little different in the aspect that more people deal with passive income. As a CPA, are you seeing the same thing? Are you seeing more people doing syndication style investments over single family homes right now?
Yes, we definitely see that. And I can speculate about the reasons for that. Okay. Thanks. Okay, David, thank you. Okay. So I can speculate as far as the reasons for that. Okay, the reasons for, in my opinion, for that shift from direct ownership to syndications is because it's less work. One reason, and nobody wants to do more work, and people figure out, hey, if I can get similar return on investment with less risk, where I don't have to worry about toilets, and midnight calls from tenants, and people trashing the property, stealing my AC, copper pipes or whatnot. Okay, so sure. So that's easier. You just put money in syndication and somebody else manages that for you. Also, a lot of people realized that uh, they are not as good in evaluating and managing investments as they thought, and
That's
it's
me.
easier and it's easier to let professionals handle that. And one other reason is very simple. Syndications are very heavily marketed right now. If you look around, like how many podcasts were talking about syndications 3 years ago as opposed to now? Everybody is talking about that. So there is a lot of that. We have many, just like you guys, like you have a lot of doctors as clients. So do we. And I specifically mention doctors because there is a group and the website and that whole group of doctors. They actually, like, the website is and the company is organized by physicians who created that group, who teaches other physicians how to invest in real estate. And all they do is they promote syndications, for their fellow physicians and explain it. And there are multiple places like that. So yes, it's a good thing to do, but one thing people tend to forget sometimes, that when you entrust your investments to somebody else to manage, in this case that syndicator, that's exactly what you do. You trust another person with your money. Okay, now if you put your money in Quest account, it does not mean that you need to do due diligence on Derek. Okay, and the reason why I'm saying that is because Derek is not doing anything with your money. Okay, like he investing that. Okay, Derek will not lose your money, right? Now, like, or Quest. But when you put it in syndication, you are literally giving money to somebody who can either quadruple your money or lose it. And what people forget about is that everything depends on the person who runs the syndication, the syndicator. And if that person is ethical, experienced, and I don't even know which is more important, both, like, being unethical or being inexperienced, both can ruin the project. And I have seen a lot of people just like putting their money at a syndication that gave them a pro forma proposal. Like, guys, come on, like, is that simple? Do you, like, is it that simple? Then let me get your money. I can lose it just as good as just as good as other guys. Okay, so be careful when you do syndications to do good research on people who run it. It's more important than research on the property they bought. Researching property is their job. Your job is research the people who run it.
So I love that answer. There's so many people out there right now raising capital for everything. So if you're not doing the right due diligence, or if you just don't feel comfortable with it, don't do it. And that's how I feel.
Especially crypto.
Yeah.
What's that guy's name in crypto?
I know who you're talking about. I'm not going to mention the name, but yes. So, Michael, before you head out, any last minute words or anything? I got your website up here. Posted a couple of your links, like to your Facebook page and those type of stuff. So before we close out today's video, I know in the beginning we had some minor issues. So if you did miss the beginning aspect, this whole thing was recorded. So I can get the link out to everyone so they can rewatch it as well. But any last minute things before we head out, Michael?
Sure, my short last time a piece of advice for everybody would be to think about business before you think about taxes, and before that, family. So I would put that sequence. Think about your lifestyle and your family first, then your business, and and taxes should be the last in importance when you make your decisions. With that is I hope everybody has great holiday season, wonderful next year, very prosperous, successful, and peaceful.
Awesome. Well, thank you guys. Make sure you check out his website at reitaxfirm.com. I have it posted right down below. And we'll see everybody next week and have a great holiday. Thanks, Michael.
Okay, thanks, Derek. Thanks, everybody who was on the call.